is Saks Fifth Avenue in trouble, and what does private equity have to do with all of this? I'm Sammi Cohen, and this is Social Currency, a podcast that unpacks the stories that are shaping business, culture, and the intersection of the two. Hi, everyone, and welcome back to Social Currency. I'm Sammi Cohen, and today we are digging into a retail scandal that has a little bit of everything: private equity power plays, broken promises, and a $2.65 billion luxury merger that's now unraveling in public. Of course, I am talking about Saks. A few weeks ago, I did a video on my Instagram and TikTok channels where I covered the history of Richard Baker. He is the mastermind behind the Saks and Neiman Marcus merger that went through at the end of last year. In this video, I talked briefly about his repeated history of pillaging great retail institutions and letting them go bankrupt while he holds onto the land and either sells or redevelops it. Once one of the crown jewels of American luxury retail, Saks Fifth Avenue now finds itself in a financial and reputational mess. Bond prices have cratered, vendors are pulling out, and small brands are getting stiffed while executives scramble to sell off art and jewelry just to make debt payments. And here's the thing, this isn't a story about just one department store. It's a case study in how private equity can gut a brand, how debt can disguise dysfunction, and how small businesses are often the ones that are left holding the bag. So let's break it down. Back in 2024, Saks Fifth Avenue and Neiman Marcus announced a $2.65 billion merger led by Hudson's Bay Company, aka HBC, under the leadership of real estate and private equity mogul Richard Baker. Now, on paper, this looked like the ultimate power move. It was combining two of the most iconic names in luxury retail to create scale, drive synergies, and create a luxury retail behemoth. But insiders knew that there were cracks from the very beginning. Baker had long targeted these brands not just for their retail potential, but for their real estate. Over the years, he'd acquired Lord & Taylor, Hudson's Bay, Saks, and other retailers. In 2005, he formed a private equity firm called NRDC. They buy massive retailers with valuable real estate. He's been known to acquire companies, rack up hundreds of millions of dollars of debt on them, if not more, and then they go out of business. I won't go into all of the details for each of his real estate deals, but I will mention two of them which are particularly interesting. His firm bought Lord & Taylor in 2006 for $1.2 billion, but by 2019, he ended up selling Lord & Taylor for around $100 million. His firm retained the real estate though. A year after the deal closed, Lord & Taylor filed for bankruptcy protection and closed all of their stores. Yet the surprising thing is that Baker said that he made a profit on the company that far exceeds the initial investment of $1.2 billion. And this is because he sold off some properties, including the flagship location in New York, for $850 million and redeveloped the rest. He's famously quoted as saying that the Lord & Taylor situation was a monster win. Obviously, that is incredibly tone deaf to anyone who worked there or any of the customers who were loyal and loved shopping at their store locations. And then there was the massive dumpster fire that is Hudson's Bay, the great Canadian retailer. He led the takeover of Hudson's Bay in 2008. And if you're unfamiliar with Hudson's Bay, it's the oldest retailer in North America, and it was 355 years old as of this year. And as of 2025, there were around 80 stores still open. To many Canadians, it was a retailer that was also a symbol of national heritage. In 2020, Hudson's Bay was taken private, meaning that it was no longer publicly traded on the Toronto Stock Exchange. And ever since Richard Baker's private equity firm took over, the stores have been on the decline. When the Neiman Marcus and Saks deal was finalized, they decided to spin off Hudson's Bay into its own standalone company. And fast forward to this year, Hudson's Bay is nearly $1 billion in debt, and they filed for creditor protection in March. The company owed $950 million to almost 2,000 creditors, including major brands such as Nike Canada and Ralph Lauren. And they decided pretty recently that they are going to close all of their stores and liquidate everything. And in yet another telling move going back to Saks, Baker split Saks e-commerce from its physical stores in 2021. At the time, the separation allowed Saks.com, which was doing around $1 billion in annual sales, to raise money to fuel its growth. The venture capital firm Insight Partners put up $500 million to take a minority stake in Saks.com, which valued the business at $2 billion. They said that the money was going to be used to invest in faster shipping, easier returns, and better customer service. And one more historical reference before we get to today's situation. In 2021, Baker spoke at a Saks town hall meeting. And this was all directly quoted in a Wall Street Journal article where he said, "I have no interest in buying Neiman Marcus. My only interest is in us putting Neiman Marcus out of business. There's no reason for Neiman Marcus to exist if we do our job right." And plot twist, of course, less than 3 years after saying these now famous words, he was trying to buy Neiman Marcus, a company that he had previously said that he wanted to put out of business. Let's talk about where things are falling now. So when the Saks Neiman Marcus deal closed in late 2024, it was funded by a $2 billion bond and backed by names like Amazon, Authentic Brands, and Salesforce. And the entire deal looked very ambitious. But behind the scenes, Saks financials were already shaky. And by May 2025, Saks bonds were trading at 47 cents on the dollar with a 34.5% yield, practically screaming distress. And Saks was also facing a $121 million interest payment due in late June. As one analyst put it, this was a wowza situation. And let's now talk about the money or lack thereof. Saks Global was hemorrhaging cash. To make ends meet, they turned to aggressive financial gymnastics. For starters, they overvalued their inventory, and they did this pretty massively. They claimed $100 million in artworks and another $100 million in high jewelry on their books, but here's the catch. The art was mostly unsold framed prints that were purchased for around $2 million. And as of this year, only $50,000 worth has been sold. Same story with the jewelry. Saks bought $33 million worth of diamonds, and they valued that at $100 million, but they also gave half of it back to the vendor, and it's still on the books. So this is very clearly a company that is aggressively overvaluing its inventory. Meanwhile, the Saks Fifth Avenue Club, and this was a program with personal styling suites in luxury hotels, these were projected to make $4 million a year per location. But in reality, it's closer to $500,000. So they are bleeding money. And then there is the real estate mess. Saks owns a 62% stake in HBS Global Properties, which carries a $599 million commercial mortgage-backed loan, and that debt matures in August. So it's underwater and badly. The properties were appraised at $525 million, down 53% from their 2019 valuation. And to refinance that, Saks might need to cough up $170 million. And they're doing all of this while trying to make interest payments and avoiding default. So what do you do when your house is on fire? Apparently, you ghost your vendors. In February, Saks sent what was supposed to be a peace offering to the 2,000 brands that it works with. They sent a letter acknowledging late payments and outlining a new plan. They said, "We'll pay you within 90 days going forward." And rightfully so, many brands were outraged that this was happening, and this was the final insult. Within the fashion industry, this day will go down in history as the Valentine's Day Massacre. Multiple designers, some owed six figures, told the Business of Fashion that they're walking away. Others say they'll drastically reduce shipments, and one fashion exec called the letter arrogant and disrespectful. And yet, another person said it's wrong and misleading to act like this is helpful. Now, the issue is that Saks made massive orders that they had no intention or liquidity to even pay for. And for small brands, especially in the fashion industry, even $10,000 in unpaid invoices can wreck cash flow. Some vendors also said that payment exceptions were made for brands with personal ties to leadership or part of a powerful conglomerate, meaning some players were protected while others were left in the dark. And here's where it gets a shade darker. In a call with merchants and his executive team in May, the CEO of Saks Global, Mark Metrick, allegedly said, "In this new world order, you're either a hydrant or a dog, and we're the dog." So First, that's a crazy statement, but it's clear that he still has no care or empathy for the small businesses who provided inventory to Saks in good faith that they would be paid in a timely manner. And so now it's seriously jeopardizing their businesses. You can imagine how that comment from Mark went over. And it's also just incredibly idiotic to say something like that when so many top executives from Saks are already leaking the company's inner workings to media outlets. And one of the media outlets that has been covering this Saks situation so well is Puck, which, by the way, if you're not already subscribed to Puck, you really should be, because they are the best at this coverage and they have all of the latest updates. Now let's actually zoom out a bit more. Richard Baker is not a traditional retail CEO. He's a real estate guy. And this entire play has always been about maximizing property value first and operations second. Baker sees these department stores not as brands to be built, but as assets to be flipped, repackaged, or monetized. In 2021, he even floated the idea of building a casino on top of the Saks Manhattan flagship. He scrapped it, and of course, they never went ahead with the idea, but the fact that this was even on the table tells you everything that you need to know. The bigger point here is that this isn't just a Saks problem. This is a pattern that we've seen before with countless other big box retailers. And I recently covered the Red Lobster situation on my Instagram page, where I talked about how private equity loaded up the company with debt and extracted value. And this happens all throughout the industry, where they leave the wreckage behind and the businesses are unable to keep operating. Saks is just the latest chapter in Richard Baker's private equity slaughter. So where does this all leave us? Saks is now in a financial freefall. Its relationships with brands are fractured, and the deal that was supposed to transform American luxury retail is now a cautionary tale. But maybe the bigger takeaway is this. We're watching what happens when finance eclipses vision and when short-term extraction replaces long-term value. And I do want to say this, even are critical of this private equity play in retail, I also need to acknowledge the fact that these businesses were on a downward trajectory far before Richard Baker got involved. There's a reason why all of these big box retailers have gone through bankruptcy over the last decade. People are making their purchases for most things online now, and it was going to be challenging for all of these companies to turn things around. I believe that it really could have been possible. It obviously would have required reasonable downsizing and a re-examination and realignment of operations and strategy. And I spoke about this approach in last week's episode with the Barnes & Noble comeback, which is actually a shining example of a company who was able to turn things around, and they're growing now after about a decade of contraction. If you're a founder, a brand, or just someone trying to make sense of the retail world today, the Saks meltdown is a flashing red light. Pay attention to who holds the power and look at what motivates them. Look at their track record and how they are really making their money. Because sometimes the people who are running the business aren't really thinking about the business at all. I'd love to hear what you think about all of this. Was this collapse inevitable? Could Saks have taken yet another path? And if you found this breakdown helpful, please feel free to leave a review, share the show, and stay tuned, because there's always more happening beyond the headlines. Thanks for listening to Social Currency, and I will see you next time. Thank you so much for listening to today's episode of Social Currency. I've been wanting to launch this show for so long. I can't tell you how excited I am to do this and how thrilled I am that you're actually here listening. It means the world to me. If you liked what you heard today, please rate and review the podcast, because it massively helps to support the work I do to bring the show to life. And if you want to keep up with the hottest business lore in real time, follow me on Instagram at Sammi Cohen Talks, and subscribe to my newsletter, Social Currency, which is linked in the show notes. Social Currency is a production of Social Currency Media and Money News Network. The podcast is hosted and executive produced by me, Sammi Cohen. Social Currency is produced by the Money News Network team. See you next time.